Good evening. Please come to the next paragraph where we are going to deal with a small case study which will require you to understand the 5 steps. Okay. MaxCare Inc. entered into a contract with one of its customers to sell a machine and provide free servicing for the next 3 years. The total consideration under the contract is $6,000. And MaxCare expects to receive the full amount as agreed. MaxCare generally sells such a machine for $5,000 and charges $750 per year for the servicing. So now the question in the exam could be that identify the 5 steps in the revenue model as per IFRS 15. What are the 5 key components of this? So first of all, let us check whether there is a contract. Identify the contract. Identify the contract. Who are the 2 parties involved here? MaxCare and customer. So there is a contract here, contract between MaxCare and the customer, where MaxCare will sell a machine and provide free service for next 3 years, and the customer in return will pay $6,000. That is the contract. Okay. Next is identify the performance obligation. So which are the 2 performance obligation here? The 2 performance obligation here are sale of machine and providing free service for next 3 years. Obligation to provide free service for 3 years. Then determine the transaction price. The transaction price is agreed and expected to be received $6,000. Next task is critical. Allocate the transaction price to each performance obligation. The standalone value of the machine is $5,000 and the transaction price identification for service obligation is $750 into 3, that is $2250. Now 5,000 and 2250. In that ratio, we will apportion the $6,000 transaction price. So the transaction price of $6,000 will be allocated as follows. Towards the machine, 5,000 divided by 7250 into 6,000. 4138. 2250 divided by 7250 into 6,000. 1862. This way. And this 1862 will be recognized over 3-year period. Means over 36 months. So depending upon the date of transaction, if suppose 6 months are covered in this period, 6 by 36 of 1862 will be recognized in this period. Okay. Now next question for you is, dairy products enter into with publicity aid agency. So based on whatever we have learned till now, questions will come. Dairy products enter into a contract with publicity aid agency for an advertisement campaign to increase the sale of the product. Advertisement would be aired on the television after due approval from the central authorities of dairy products. The commission for the work was fixed at $30,000, out of which 50% advance is to be paid on signing the contract and 50% on completion of the contract. Required, state the accounting treatment in the above case. How will the accounting be done? How will the publicity aid agency do the accounting? When it is aired on television, what about this first 50% advance they will receive? Will it be recognized as revenue? So this will be recognized as a liability. And then when the ad will be aired on television after due approval, then they will recognize the revenue. So till that time, the amount collected will be treated as advance from the customer. Publicity aid agency will recognize revenue only when the advertisement is telecasted on television, as only then the performance obligation will be met. So this revenue recognition event would be when your performance is complete, that is telecasting on television. Until then, the amount received, whether as advance or for completion of the project, will be recognized as a liability. Now come to next wonderful question number 6. Is it there? Question number 6. Okay. Which of the following will fall within the scope of IFRS 15? Revenue from contract of insurance, then revenue from operating lease, revenue from non-monetary transaction between entities engaged in same line of business to facilitate sale, revenue from contract with variable consideration. So you follow the elimination rule. Is revenue from contract with customer under the scope of this standard? No. Revenue from operating lease? No. Revenue from non-monetary transaction between entities engaged in same line of business to facilitate sales? No. What is left? Revenue from contract with variable consideration. Okay. So which option is right? C is right. This standard covers revenue with customer with variable consideration. But for the other first and second, different standards are applicable. And this standard specifically says that if there are non-monetary transactions between entities in the same line of business to facilitate sales, then it is not covered. Now, dear student, come to next question. What is that question number? 7. Z Limited is a manufacturer of electronic product. It enters into a distribution agreement with P Limited. The terms and conditions of the agreement provide the following. P Limited will obtain the title to the goods and will sell them to retailers. P Limited will earn a fixed margin on the product sold to retailers, but will have no authority in establishing the selling price of the goods for the retailers. P Limited has the right to return the goods to Z Limited if they remain unsold for 2 years. Accordingly, Z Limited sold goods worth 10,000 to P Limited. When should the sale be accounted for? When should the sale be accounted for? Haji? Immediately when the goods are sold to P Limited, or after you receive an intimation from P Limited that the goods have been sold, okay, or after 2 years, if the other party, that is P Limited, does not inform you, then only the revenue will be recognized. Either P Limited sells, 2 years have expired, but he does not intimate. Till that time, you cannot recognize the revenue. What is the status of P Limited in this example? Is it more like a agent or principal? That we'll discuss in a separate paragraph also. But for the time being, you see, although in form it appears P Limited will obtain the title, but you are not a principal. You cannot decide the selling price. Selling price is determined by Z. And there is no inventory risk also. Agent does not have inventory risk. If after 2 years goods are not sold, it can be returned back to the company Z Limited. So how should revenue be recognized in such kind of contractual arrangement? So you write the answer like this: when P Limited sells the goods, or after the expiry of 2 years, if P Limited does not return the goods. So how do you present the answer? The terms of contract between Z and P clearly state that P has a right to return the goods to Z if they remain unsold for 2 years. P will be entitled to a fixed margin and have no authority in establishing the selling price. So based on the terms of the contract Z and P, even though Z has sold goods to P, it shall not recognize the revenue immediately. Here, even though the normal sale has taken place, all requirement of 115 has not been satisfied because there is no certainty relating to consideration. One of the conditions was that consideration must be received and no effective transfer of control has taken place. The other party has a right to return the goods if they remain unsold for 2 years. The consideration will be confirmed and the control will effectively transferred to Z only when P Limited sells the goods to retailer or if the goods are not returned after 2 years. Z will recognize the sale when P sells the goods to retailer and receipt of transaction price is confirmed, or after 2 years from the date of sale if the goods are not returned by P Limited even till that date. Right. Now dear student, next question number 4. C Limited, in your book it is question number 8. C Limited is a multinational pharmaceutical company. Question number 8. C Limited is a multinational pharmaceutical company with operating divisions in 8 countries. Since each of these countries has its own legislative requirement, on 1st January 2017, C Limited has employed the services of Miller, Martinez and Ichikawa, MMI, an international management consultancy firm, to study and recommend ways to streamline their operation through corporate restructuring. For this, C Limited would provide MMI with all necessary resources. Entire process is agreed to be completed within 6 months, at the end of which MMI would present its finding to C Limited's management. For its services, MMI would be paid $5 million after 3 months and another $5 million at the end of 6 months. The progress in satisfaction of contractual obligation is expected to be in the same proportion of payment as stated. If MMI breaches any of the terms of the agreement or are not able to come up with specific recommendation, then C Limited would not pay MMI for its services. MMI is unsure about the outcome as it has never undertaken such assignment before. Oh, on what date MMI should recognize the revenue? After 6 months only if it is able to come out with specific recommendation If MMI breaches any of the terms of the agreement or are not able to come out with specific recommendation, then C Limited would not pay for its services. That means there is uncertainty evolving around the consideration that will be received. So can the revenue be recognized? The answer is no, you have to wait for 6 months. Even though you have received the advance, but that advance will be shown as a liability. That $5 million received would be shown as a liability. MMI as well as C Limited have agreed upon the following conditions. So there is a contract. C Limited would provide all the necessary resource to MMI. Consideration of 10 million will be paid. Here exists a contract, and as per the contract, the contractual performance obligation is to come up with recommendations. The obligation will be satisfied. When will the performance obligation be complete? When recommendations are stated, and hence revenue will be recognized on satisfaction of this obligation. As there is no conformity on transaction price, and satisfaction of the revenue shall only be recognized on 30th June 17, the amount received will be recorded as advance from customers. Okay. Have you solved question number 5? No. Come to question number 5 also. That will discuss from the notes. Question number 5. C Limited entered into a contract. Question number 5. C Limited entered into a contract to construct a factory building for M Limited. According to the contract, C Limited will undertake the construction work of the factory for a consideration of $2 lakh. C Limited expects to receive the full amount and does not expect any credit risk or default in payment from M Limited. C Limited started the construction activity on 1st April 2015. On 1st April 16, while the construction of the factory was yet to be completed, M Limited requested construction of quarters, that is residential building for its workers, next to the factory premises. Already you have a factory. Now this is an example of modification. And the contract modification says you have to construct one more building for the workers next to the factory premises. The price of this construction of residential building was negotiated separately. So both parties have agreed on this separately, and the price agreed is $1 lakh. Explain the accounting treatment for this modification. Will it be treated as a separate contract? So first of all, both parties have separately negotiated this additional asset. This modification results into creation of an additional asset. The price that has been negotiated is the standalone price. If these conditions are satisfied, it will be treated as a separate contract. So the answer is it will be treated as a separate contract. In this case, the construction of the residential building for employees is a separate contract as the scope of activity increases due to modification. This modification requires construction of an additional building, which is distinct from the factory building as agreed in the initial contract, and the price of the contract reflects the stand-alone price for the additional construction activity. So this you have to write in the exam, that it is a distinct product, price reflects stand-alone price. Hence the revenue from initial contract and modification resulting into distinct performance obligation will be accounted separately over a period of time based on the progress in the satisfaction of the performance obligation. So that means we will follow over the time period of revenue recognition. Now one more important thing, how to measure progress in case where the revenue has to be recognized over a period of time. Okay, This construction of this building will take 3 years. Standard says you can recognize revenue over a period of time if it takes many years. But how much? For that, we need to compute progress towards complete satisfaction of the performance obligation, which is what in many standards they say percentage completion method. Okay, stage of completion or percentage completion method. So, as per the 5-step approach, revenue shall be recognized either over time or at a point of time based on satisfaction of performance obligation. Okay? So, 2 methods they have allowed you, at a point of time or over a period of time. Measuring progress towards complete satisfaction of performance obligation is a basic requirement while recognizing revenue in case of long-term contract. This percentage completion is very, very important in case of long-term construction contract. That is where the work may spread over multiple accounting years. Because a wrong calculation of the progress will result into wrong recognition of revenue. So, an entity shall recognize revenue when or as the entity satisfies a performance obligation by transferring goods or service to a customer. An asset is transferred when the customer obtains the control of the asset. Now, today we will see exactly what do you mean by control. Because the standard says performance obligation is complete. Complete the line when the control is transferred to the customer. So what do you mean by control is transferred to the customer? Control of an asset refers to ability to direct the use of and obtain substantially all of the remaining benefits from the asset. Control means you can use it the way you want, you can enjoy the benefits from that asset, and you can also prevent the others from enjoying the benefit of that asset. If that condition is satisfied, it means that party has the control. You use it, you enjoy the benefit, and you prevent other entities from use or enjoying the benefit from that asset. Is it right? What do you mean by benefit? Benefit means either inflow of cash or saving in outflows. Control can be exercised in many ways. For example, using the asset to produce goods or provide services. That means you have the control, you can use it to produce goods, provide services, including public services. You can use the asset to enhance the value of other assets. You can use the asset to settle liability or reduce the expenses. Sell or exchange the asset. To control the asset means you have the power to sell the asset, to exchange the asset, place the asset to secure a loan. These are the examples in which you control the asset, holding the asset. So now we will first discuss recognition of revenue when control is transferred at a point of time. At a point of time means immediately. Okay. So you buy this pen, pay 100 rupees, he gives you the pen. How will revenue be recognized? At a point of time. Okay. If suppose you go and watch a movie, how will that theater owner recognize revenue? After the movie is screened. At a point of time or over a period of time? At a point of time. But if you are constructing a building which will take 3 years to complete, then over a period of time. So, point of time when customer obtains the legal title, transfer of physical possession, customer retains significant risk and reward of ownership, customer's acceptance of the asset, an entity has the present right to payment. Okay. 5 points again. Customer obtains legal title, physical possession, risk and reward, acceptance of the asset, and the entity, that is the entity which is selling that asset, has a present right to payment. Okay. If these conditions are satisfied, the control will be passed at a point of time and then the revenue will be recognized. What they have also mentioned below, that these are indicative conditions, illustrative conditions, and the indications will not be limited to the above circumstances. Is it right? Say yes. So again, this chapter involves lot of judgment. So in this case also, whether we should recognize revenue over a period of time or at a point of time, management may have to apply their judgment also. So these examples will help you to identify that the control has been transferred. Now, indicators of control passed over a period of time. Now, in this case, revenue will be also recognized over a period of time. The standard says if any of the following three conditions are met, welcome. You will follow over the time concept. So, which are these three conditions? ABC. First is the benefit is transferred to the customer when the entity is performing its obligation. This is the easiest one. Suppose a company is providing annual maintenance service, AMC, annual maintenance contract. And what is the service? Every month they will provide cleaning service. How will they recognize revenue? Every month they will recognize revenue. If nothing specifically is mentioned, then it will be recognized evenly over this 12 months period. Right? Teacher is providing you IFRS for 3 months. How will he recognize revenue? Over 3 months or after the completion? Yes. So here the benefit is transferred when the entity is performing its obligation. So the simultaneous transfer of benefit to the customer. But in second point, which is normally applicable to industries which takes a lot of time to create an asset on behalf of the customer, entities' ongoing efforts create or enhance the asset for the customer. Example would be construction of a building. Construction of a building. Example read from the book. Buildcon PLC undertakes a contract to construct a factory building for one of its client. No problem. Here the asset will be created over time. So it might take 4 years to complete. Revenue shall also be recognized accordingly over the period of time. So in situation like this, where you are creating or enhancing an asset for the customer, revenue will be recognized over a period of time. So basically they have brought the construction companies also under this IFRS 15 through this line. And point number C, entity's performance creates a unique or specialized asset with no other alternative use to the entity, and the entity has a right to recover payment for performance completed. Okay. Say for example, there is a company Multicon. Multicon has a customer Bingo, and Bingo says you construct a specially designed vehicle for me. Specially designed. It cannot be used by others. It is of no use to multi-con also. It cannot be sold to other customers also. So now in this case, it will take some time, say 2 years, to complete the manufacturing or designing of this vehicle. There is a condition: in case if Bingo does not buy after I complete my work, Bingo will have to pay for the performance that have been done on this machine. Is it right? Can this multi-con recognize revenue over 2-year period? The answer is yes. Are we required to satisfy all three conditions for over the time revenue recognition? No. Any of the three, because these three are very different. Here I am rendering the services, customer is enjoying the benefit. Here I am constructing an asset or enhancing an asset for the customer. Here we are constructing a specialized asset for the customer which others cannot use, and the seller has a right to recover payment for performance completed. Now, in case if you have to recognize revenue over a period of time, right, then what you have to do? You have to measure the progress or the performance obligation. Progress or performance obligation. Because otherwise, how will you recognize revenue? If the client says we'll give you 10 crore rupees if you construct this building, how that 10 crore rupees will be allocated? Will you allocate it equally over 3 years? Or on the basis of stage of completion? Stage. But how do you compute the stage? Okay. So measurement of the stage of completion is also a very important aspect in the revenue recognition, especially in the long duration contract. Now what you have to do? You have to apply either output method or input method. Both methods are allowed. Output method means you can take the help of a surveyor. Go to some engineer, architect, technical expert, surveyor. Ask him, can you give us a certificate of the performance of the work done? So there are agencies who do this, professional agencies. So they will give you a certificate that 60% work has been complete. Or it may be based on appraisal of the result achieved. Milestones reached. Different industry may have different terminology. Software companies will say milestones. If this work has been done, so many milestones have been achieved. So according to the nature of the industry, you take the certificate and check how much percentage of work has been done, unit produced or delivered, etc. Here the thrust is on ascertaining the revenue that can be billed to the customer for obligation satisfied till date or any similar element related to revenue. So based on the certificates of the work done, bill is raised, which we will call in this chapter progress bill. Okay. Example of output method: report given by an expert that 45% work is complete. Second example, physical proportion of the work done. Like, suppose 10,000 cubic meter work has to be done. 6,000 cubic meter work has been done. Okay. So like on the road, both side, this is road. If you see both side, they put lot of, they make pavements. Okay. Parking or walking space. They will measure this. This much work has been done. This much is pending. So this can be measured in physical terms. Okay. Another example is based on output revenue. Total value of the contract is 20. Architect certifies that work equal to 12 million has been performed. So what is the percentage completion? 12 by 20, 60%. Are this list exhaustive? This is indicative. See, these are examples of stage of completion. Similarly, 12 by 20, 60%. You are right. You are genius. Continue. Input method. Input method means here we use cost incurred upon total cost. In basic costing classes also this method is taught. Percentage of work done equal to cost incurred till date upon estimated total cost. Or it can include resources consumed. It can be based on labor hours also. If a work will require 2000 labor hours, 600 labor hours are complete. One can take 600 by 2000. Cost incurred, time, machine hours, etc. These are input method. Depending upon the industry, the kind of work, one can take any of these methods for estimating the work performed. Now, one example which we will give you, suppose contract cost will take $10 million and you have the internal record, you can say 7 million cost we have already incurred. So therefore 70% work has been complete. Then the standard says if the entity's efforts or inputs are expended evenly throughout the performance period. 3 years is the performance period and the work is spread evenly over the 3-year period. Only in such cases one can apply straight line method. That is, efforts or inputs are expended evenly throughout the performance period. It may be appropriate for the entity to recognize revenue on a straight line basis. Like the example of that maintenance service which I have given. Maintenance service is for 12 months. So, is the amount of work done different in each month? No, or same? Cleaning service, na, every month he comes and he does the same work. So 1 by 12, 1 by 12, 1 by 12. Teacher is teaching for 3 months. Is the efforts or input evenly spread? No. What depends? Equal. Internal audit work is done over 1 year period. Equally spread or on the basis of number of vouchers audited? Evenly spread? Yes, but you can use number of vouchers also as a percentage completion or number of hours spent by article over the total expected time, percentage completion. You don't apply all this. Directly whatever comes goes into the pocket. Selection of method is very important. We have discussed about 8 or 9 methods. But one has to choose the most appropriate method in the given scenario so as to arrive at proper recognition of revenue. See one example. There is a company which has a contract to manufacture 20 products. 18 are produced. So if I apply this logic, 18 are produced out of 20, you will say 90% work has been done. But the question says, the 18 products which are completed will only constitute 30% of the total expected cost. So what is the right method of computing the progress? 18 by 20 or 30%? Yes, so here the output method might lead to a misleading picture. There will be a mismatch of cost and revenue recognized. If I use output method, you will say 90% revenue should be recognized. But actually my cost incurred is only 30%. So this will not use. the entity needs to estimate the relevance and appropriateness of the method being used to measure the progress. If the circumstances and cost structure is changing, entity can also consider the need for change in the method also. If you change the method of calculating the stage of completion, it will be called as a change in accounting estimate. Measuring the progress is an estimate only, and then it will be accounted as per which standard? IS 8. Okay. Now we'll come to some special point. Specific guidance is provided in relation to revenue arising from provision of license relating to intellectual properties. So the standard has given you specific guidance on how to recognize revenue from license related to intellectual properties. Like companies have got some intellectual property. It allows other to use that intellectual property. How to recognize revenue in that case? There are two types of situation possible. One, if the license provides the right to the licensee to use the intellectual property from the day the license is granted. Once the license is granted, now you can start using it. Revenue will be recognized at a point of time. Okay. Like some softwares you can download from the website and then you start using it. When will they recognize revenue? When you grant the license to the person and the person has made the payment, you grant the license. But then there are many intellectual properties where the license is for a period of time. License is for like a franchisee right. Franchisee right is given for 5 years. For 5 years you can use the brand name, trademark of a company. Then in that case revenue is recognized over a period of time. What about authors who give the copyright to the publisher? Now again one has to see their agreement. Okay. Sometimes they take an amount of money and they say you can now use that book as much as you can, no restriction now. So he has given his license, recognized now. But many times it is for a period of time, 5 years, 10 years. Then recognize the revenue from that license granted over the period of time. Okay, now one more question for you. Questions will come in between so that you will be awake. Nigel and Company is a London-based firm of architect. So you have to think whether revenue will be recognized at a point of time or over a period of time. That is the theme of this question. Is a firm of architects and structural engineers specializing in the restoration of old heritage sites. Okay. On 31st December, they received an $8 million contract from the Peruvian government. There is a country called Peru. Government is called Peruvian. To restore a 600-year-old Inca worship site on the Peruvian Ecuadorian border. Okay. So what is the performance obligation? Restoration of a 600-year-old Inca worship site. Some kind of temple probably. Old temple restored. Nigel and Company has estimated they would require 2 years to complete the restoration project. The Peruvian government would pay Nigel in the following manner: 4 million immediately, 4 million on completion. These charges pertain only to Nigel and Company's consultation and design fees. Consultation and design fees only. Nigel and company would have charged 5 million for consultation and 3 million for design. So 8 million they will apportion as follows: 5 million towards consultancy, 3 million for design. It has also been specifically agreed to follow Peruvian government's recommendation in addition to their ideas in order to preserve the cultural heritage of Peru. Required state with reasons whether the revenue from service shall be recognized in the financial statement for year ended 31st December 20x7, and if yes, how. They should have asked how the revenue will be recognized. At a point of time or over a period of 2 years. What is the work you have to do? Consultancy and design. You don't have to construct or do restoration of that workshop. That only you have to give the suggestion, and that will be done by other entities. How will you recognize revenue? At a point of time. Because here you are not constructing an asset or enhancing the value of an asset. So you will present your design, present your consultancy report, and then after the revenue would be recognized. So answer: the enforceable rights of both Nigel and company as well as Peruvian government have been agreed upon. There is a contract. Then there is a performance obligation. Okay. There is a consideration of $8 million, and the manner of settlement have been agreed upon. So all the features of contract with customer that needs to be recognized, they have been satisfied here in the first paragraph. Consideration we have discussed. As a result, the revenue from service will be recognized by Nigel and company. However, here problem is in identifying the performance obligation and recognizing the revenue based on performance obligation. Two performance obligations are involved: consulting, designing. As for both the performance obligation, the criteria for recognizing the revenue over time are not met. Why? While you are preparing the report of consultancy, is the customer getting any benefit? While you are doing this designing and sketching, is the customer getting any benefit as the services are rendered? No. Is it resulting into construction of an asset, enhancement of an asset, construction of an asset which is unique, specific? No. Since none of the three conditions are satisfied, over the time revenue method cannot be used. So revenue will be recognized at a point of time when the obligations are fulfilled. Till that time, whatever amount you have received will be treated as advance. So revenue will be recognized as follows. Two performance obligations are involved: consultancy and design. First, to allocate the transaction price 5 and 3. As and when these obligations will be satisfied by Nigel, the revenue will be recognized for each of the obligation at a point of time. Is it right? Now next paragraph is additional indicators of control. There will be some examples now, some situations now, where we will check whether control is transferred or not. So the examples, those are printed here, are the examples where control is not transferred. Control is not transferred. So if you come across this situation, revenue will not be recognized. Following are the circumstances when entity has not passed the control. First, when the entity retains an obligation for unsatisfactory performance not covered by normal warranty provision. When an entity retains an obligation for unsatisfactory performance, which is not covered by normal warranty. Now, in that case, revenue recognition will not take place because there is uncertainty regarding consideration. See one example. Perfect Company is a manufacturer of stereos and offers a warranty of 6 months free repair period. That is their normal warranty for all its models. However, a manufacturing defect is revealed in the model number 234 and Perfect Company has declared that it will refund the money for the model even after the warranty period is over, but before 1 year from the sale. Now here the revenue recognition will be postponed because there is uncertainty regarding the consideration. So what should be the accounting treatment? In this case, the risk of ownership remains with Perfect till the end of 1 year from the date of sale. This is because the customer has an option to return the product within a year from the date of sale. Do not recognize revenue. Wait for a year. Recognize revenue for those goods which have not been returned by the customer. So this is example where there is uncertainty involved regarding the actual sale that will happen. Risk is with the entity only. Second example, when the receipt of revenue from a particular sale is contingent on receiving of revenue by the buyer from its further sale of the goods. This is also quite common in case of automobile industry. So BMW car company will sell a car to a dealer. Dealer will sell it to a customer. Now these are very expensive cars. Will the dealer take the risk on itself? Depends. It depends. But suppose in our example, dealer will say, I will make you payment only if I am able to sell it to a customer. When the receipt of revenue, that is talking about this part, is contingent on the receiving of revenue by the buyer from its further sale. Should we recognize revenue here or at point number 2? 2. So generally in the case of car dealership, the dealer takes cars from the manufacturer on consignment. So this is like a consignment sale. This is like sale to an agent. And as we have discussed and will again discuss, payment in some agreement, payment is not made from dealership to the manufacturer until the dealer sells the car onto a third party. The dealer often has the right to return the cars to the manufacturer if they are not sold within a specific period of time. And this is again a very usual example. Goods are shipped subject to installation, and installation is a significant part of the contract which has not yet been completed by the entity. Will the revenue be recognized? No. But you underline, installation is a significant part of the contract. If it is just a routine work, like when you sell a TV, what the customer has to do? Customer has to take the TV out of the box, plug it and start. It will work. It doesn't require any significant installation activity. But if you buy a generator set, a heavy machine, or this projector which you see every day, it is not a normal installation, then in that case, revenue will not be recognized until the installation work is complete. So see this example for you. Heavy Machine Limited sells a machine worth $25,000 to superfine polyester. Machine has to be embedded into the ground before it can start manufacturing the goods. So this is a complicated installation process. Therefore, this company, Heavy Machine, cannot recognize the sale as revenue until it completes the installation of the machine. Point number 4, when the buyer has a right to cancel the purchase for a reason specified in the sales contract and the entity is uncertain about the probability of return. This is popularly called goods sold on approval basis. Buyer has a right to cancel the purchase. Okay, and we don't know whether he will like it or he will not. Wait. In such example, what you have to do? Wait. Till how long? Till you receive the approval that yes, I want to buy this. Or implicit approval. The buyer does something which amounts to approval only. So I have given you one IFRS book. You take this IFRS book, read it for 1 week. If you like it, then you pay for it. The student has written his name only, address also, phone number, WhatsApp number, Telegram number, and some God's name also at the top. No. What is he doing? He is approving the contract. Is it right? So approval. Till that time, do not recognize the revenue. Fifth situation when you should not recognize revenue, when there is no revenue in spite of outflow of inventory. For example, replacement of goods during warranty period is not recognized as a revenue for 2 reasons. One, revenue was already recognized, and secondly, you have not received or will receive any consideration for the replacement of the damaged goods. So example for this, T Limited purchased plastic containers from S Limited worth rupees 6,000. The terms of the sales contract stipulated that in the event of damage to the container, S Limited will replace the container free of cost to T Limited. On their arrival at T Limited's, 50% of the consignment was damaged. Though S Limited would replace the damaged goods, he could not recognize this outflow of inventory as revenue. Okay. So these are the examples of situations where revenue recognition will either be postponed or will not be recognized at all. Next is specific transaction. Now the standard also deals with 5 or 6 specific type of transaction. When will revenue be recognized here? Principal versus agent. Principal versus agent. So you want to watch a movie, okay? So you will book a ticket on some website or some app called Book My Show. So you are the customer. You will book a ticket here, 400 rupees. Then, no, more than that. No, nowadays for one person they charge 400, 500 rupees. In the PVR theater, recliner seat, 600 rupees, 800 rupees. And then they will give you one message on your mobile that you show this message to the theater Go to PVR theater and you show that message on the mobile phone, confirmation that you have a right to see. This message is your right to watch the movie. Who is responsible for actually screening the movie? PVR. The question is, how will these two parties recognize the revenue? Okay. How will the two parties recognize the revenue? First of all, after the movie is screened, okay, understood. Then how much revenue Book My Show will recognize? Huh? What is their arrangement? They will get 40 rupees, 10% commission. So will they recognize 40 or 400? 40. Why? They take 400 rupees from you. So now one has to see whether he is acting in his capacity as an agent or principal. If he is only acting as an agent, then he gets commission. But if he is acting as a principal, then he will recognize entire 400 rupees. What this company can do, it can tell PVR how many seats you have in that theater. He will say 1000 seats. I buy all the 1000 seats. Okay. I pay you entire 3 lakh rupees for those 1000 seats. Now I will sell the ticket at whatever price I want. Even if some seats remain unsold, I'll bear that loss. Now tell me how much revenue they will recognize. Then 400. But if Book My Show only says, I will bring the customer to you and then I have no risk. If your theater is empty, I have no risk. My only task is to bring a customer in front of you. I am not responsible for watching or showing the movie. I am not responsible for any loss that will take place. Then in that case, he is only an agent. So one has to again read the agreement carefully. Same problem can be a principal also. In the same example, it can be an agent also. Who takes the risk? One has to also look at the risk angle. If you are only just providing a platform where people come and book the ticket, you don't have a risk. You are an agent. If you book the entire theater and then you start selling the ticket and take the risk of unused inventory, then you are a principal in this example. So in principal agent relationship, the agent only acts for and on behalf of the principal. Therefore, the control of the goods and services is primarily with the principal. So one has to see who controls the goods and service. In original example, PVR controls the goods and service. But in the second example, it is the Book My Show company which starts controlling the goods and service, is primarily the principal who bears the risk and reward associated with the sale of goods or rendering of the service. Okay, so keep this paragraph in mind. This will help you to understand who is the principal, who controls the goods and service, who bears significant risk and reward associated with sale of goods and rendering of service. The agent merely follows principal terms and conditions and assumes an obligation of duties towards the principal. The entity must determine whether its performance obligation is to provide the goods or service itself. So when you are primarily responsible for providing goods and service, or to arrange for the another party to provide goods or service, when you are primarily responsible for that, then you are a principal, then you are an agent. This information is crucial for revenue recognition. Okay. Now in the standard they have given you some indicators to identify a principal. Who is a principal? Principal is an entity that controls the promised goods or service. before the entity transfers the goods or service to a customer. So first test is who controls the goods or service, and second is who takes the significant risk of sale. Second example of principle is either he will satisfy the performance obligation by itself, or it may engage some other party, for example a subcontractor, to satisfy some or all of a performance obligation on its behalf. So even sometimes you may appoint a subcontractor. Like in a theater, there are people who provide soft drinks. Your ticket cost includes soft drink also. But you may not be actually providing the soft drink. You may have just arranged for someone to provide that soft drink to the customer. But you are primarily responsible for that service. Who is an agent? An agent is a party when he is not responsible for the fulfillment. Another party is responsible for the fulfillment. If something goes wrong, people will catch hold of that other party. Agent will not suffer any loss. Second, it does not have inventory risk. Now, in that book my show example, if they purchase the entire 100 tickets or 1000 tickets, and in case if it is not sold, they will take the risk, then it is not agent, it is principal. Then in the same book my show example, if they can even decide the price, what they have done, suppose a very good movie is released, they locked all the tickets and now they decide how much I will charge to the customer. Theatre owner says, I don't bother, I have received my money. They can even charge more, they can even charge less. Then he is not an agent. But if you are an agent, you don't have discretion in establishing the prices for the other party's goods or services. Next is, agent receives consideration in the form of commission. And another example of agent is, he does not take credit risk. He does not take credit risk. What is credit risk? Credit risk means you have the responsibility of collecting the amount from the customer. The customer doesn't pay, you suffer the loss. Agents normally do not have credit risk. So how do I identify an agent? He has no performance obligation. That means he is not responsible for fulfilling the contract himself. It will be done by another party. He does not have inventory risk, does not have credit risk, he cannot fix the prices, and his consideration is in the form of commission. Because of this paragraph now, revenue policy of many entities will suffer. Like for example, how this standard is going to make a big impact on the top line. You are a company like, say, Flipkart, Amazon, e-commerce operator, okay, e-commerce companies. What are they? Are they principal or are they agent? That is a big billion question. Okay, because if you really analyze the relationship, they are more like an agent only. They are just providing a platform where vendors and the customers meet. Vendors display their product. Who is responsible for fulfilling the order? The vendor. My product is also uploaded on Amazon. Okay, so when they receive the order, it is I who have to dispatch the books or the pen drive. In case if I don't dispatch, they will cancel it. Okay. Then they don't have any inventory risk. They don't keep my inventory. Then they have no discretion in establishing the prices also. If I sell this audit book for 1,000 rupees, sell this Ind-AS book for 2,000 rupees, he just puts that price there on their website. Okay. Then consideration they receive is in the form of commission. Now that is where they make a top line increase. They receive the entire value of the goods first, deduct their 10% commission and hands over 90% to us. But what they are showing before this IFRS was there, they will show 100 rupees as revenue, 90 as cost. Effect is same, 10 rupees income, but top line goes up. Now they cannot do it. The auditor will have to read the agreement carefully and ask the management that this is not 100 rupees revenue. Your revenue is only 10 rupees. And this will happen in many businesses where they normally show gross revenue, even though you are an agent only. Make My Trip. They collect 10,000 rupees from you when they book a flight ticket. Trivago, when they book a hotel room, they charge 15,000 rupees. But are they principal or are they agent? That one has to see. Mostly they will be agent only, because they only help you to identify a hotel and they bring the customer and the seller together. They are not responsible for the hotel rooms. They will not give you hotel room. They will just give you the license or the right to go there, show this voucher and take entry into the hotel. But they do not give you hotel services. They don't have any inventory risk. If the hotel is unused for the whole year, they are not going to incur any risk. They don't have a credit risk also, because they take the money in advance. Or even if they don't take money in advance, it is the hotel who is going to recover money from the customer. So no credit risk. They don't have the discretion in establishing the prices also. Whatever the airline or the hotel asks them to charge, they will charge. And they receive commission in the form of consideration in the form of commission. So this chapter will make a huge dent on the top line of many companies, those who are agents. Is it right? So what is the revenue recognition? If you are principal, recognize gross revenue. If you are an agent, recognize the commission. Okay, that is the net amount you can retain. So when Amazon sells my book for 1,000 rupees, they hand over me 900 rupees at the end of the day. So what is their income? Only 100 rupees. That is what they should recognize as revenue. In agent's case, the entity's fees or commission may be the net amount of consideration that the entity retains after paying the other party the consideration received in exchange for the goods or service to be provided by the party. Example: Lata manufactures clothing and sends the goods to Snehal on the following terms. Now this is a good case study, and in practical world also you will come across such agreements. You have to identify what is the status of Snehal here, principal or agent. Legal title of ownership passes to Snehal when it receives the clothes. So maybe they must be billing in the name of Snehal, because the goods have to move. If the goods have to move, you must carry an invoice. Yes or no? Then Snehal company will store the merchandise in its warehouse. Very good. Snehal company does not have to pay for the merchandise until it receives payment from the third party. So no credit risk. After 3 months, if the goods are not sold, Snehal can return the clothes to Lata. So that means no inventory risk. Or pay for the goods and keep them, but that is an option. Snehal is entitled to retain a fixed amount from the sales made to third party. So that is consideration is in the form of commission. So now the question they will ask you in the exam, is Snehal a principal or agent? Agent. Why? So Snehal does not have inventory risk. It has no obligation for payment until the goods are sold to third party, and it is entitled to a fixed commission. This condition suggests that Snehal is working in the capacity as an agent in this arrangement. So revenue recognized in the books of Snehal would be net amount. And in the case of Lata Limited or Lata Company, the amount of revenue will be gross amount. Commission will be shown as an expense. Is this answer right? Now we will take a break.